And we've got our currency expert at TreasuryOne, Andre Cilliers, with us in the studio. Andre, can we start with the rand, or should we rather start with the price of oil and the effects on South
Yes.
Africa?
Well, what happens on the rand and what happens with the oil price is it's all interwaved with each other. So that doesn't really matter where we start. Let's kick off with the oil price. I think that's definitely one of the things that's at the forefront of everybody's mind. We're waiting with a bated breath as to what the fuel price will be that gets announced tonight, or that kicks in 12 o'clock tonight. And it's not been well. I've certainly not seen it being released as yet, and part of that revolves around the R1.50 fuel levy that was discounted for us 2 months ago. That kicks in again from the 1st of June. Um, if that kicks in, then we're going to get a fuel price that increases by almost R4. We'll have a diesel price that increases by almost R2. That will have a severe impact on what can be expected of our inflation rate. Inflation takes out money out of people's pockets. The fact that they have to pay more for fuel is a direct hit to their pockets. We've had a 50 basis point increase in interest rates. People with debt, home loans, etc. That's a direct hit to their income, disposable income, and that means simply that the consumer is under severe strain in South Africa. And the further you come down the income line, so the lower you go on the income line, the more severe it becomes for the people. And that's simply at the end of the day going to play out havoc in terms of what happens to our economic growth, which was already downgraded.
Well, economic growth, price of living, and the squeeze people are feeling more and more.
Yes, so things are not looking great. And if you look at the oil price and the predictions for the oil price, we're up at the $120 a barrel level, which is already more than what the average price was for the month. So in other words, you're going to start the month even on the back foot. And predictions are that that could actually even worsen and go further to the $130 and $140 a barrel level. And that's all to do with oil supply out of Russia that is less than what it was previously been. And we're not seeing any increases in production out of the Middle East. Strategic reserves that was released by certain countries, specifically the US as well, by far not enough to aid the supply of oil. So things are really looking bad, and we know that throughout the world we have a bit of an inflation problem, and this will just contribute to that problem. What one can say is if you look at the increased oil price, without your demand on that side, coming lower, simply means that for every barrel of oil that you imported that you used to pay $100 for, you now pay $120. That's $20 per barrel that goes out more. That needs to be bought in the open market in the exchange rate. So that places pressure on the exchange rate because the cost of your imports is much higher. The cost of imported food will be much higher. The freight cost will be much higher. But that will have an impact on the exchange rate as well. What can be said there is if your economic growth comes lower and demand from consumers, because they're under severe pressure, is very much lower, eventually the wheel will turn, and the lower demand will, make for less imports of oil, less imports of other products, because the consumer can simply not afford paying for it or buying it. And that in itself, very negative for economic growth, but at the end of the day, slightly positive for the exchange rate. And that's an interesting one. A lot of people always think that in good times, is when your exchange rate should strengthen. But that's actually when it weakens, because then the imported products is so much more because people spend so much more. So the vice versa is true. The lower your economic growth comes, the better the exchange rate actually does, because your terms of trade changes to more exports, less imports.
So, what is the rand doing at the moment?
Well, at the moment, we have seen the rand coming back from the 16 and the 25 highest levels. It was around 16.30. We had seen that coming back. We've traded as low as 15.45, 15.46 yesterday. But that was not because of rand strength or because of interest rates that went up in South Africa or anything. It was by far more linked to what happened internationally in terms of the value of the dollar. We had seen the dollar going from the 105, 104 and a half levels against the euro, close to the 108 levels. We're lower now again, but it went close to the 108 levels. And that's when the rand also made its move internationally. All emerging markets did quite well during that period because the dollar actually lost quite a bit of its value. But that's already turning around again, and we're below the 107 levels. So we can expect the rand to trade back closer to the 1580, 1590 levels again, simply because of the strength of the dollar. And the strength of the dollar is closely linked to with what happens with their interest rates and their inflation still being under severe pressure. We've seen in the minutes of the Federal Reserve meeting that it's quite unanimous by everybody on the Federal Reserve that the next interest rates will also be 50 basis point interest rate hikes to try and curb the inflation that sits consistently high at these levels.
Is there any other news that will affect our economy growth and also the rand? I've just been looking at a new investment plan that the presidency came out with. Do those announcements have any effect, or do people think that they will actually be implemented?
Very little. Very little effect on that. Other events that we have to closely monitor is obviously what happens in China. You know, China is some of their lockdowns. They are coming out some of their lockdowns. They are opening up their markets. That places pressure on the oil price again, once again, because that demand from oil from the Chinese side is then on the increase. But that simply also says that their demand for product is on the increase because they've imported less and exported less. So that trade comes back into the markets and that aids economies again and normalize situations and could also be a bit of a normalization on the logistics sector in the sense that ships can get into harbors and being offloaded again, and containers can become more available because the turnaround on that becomes shorter. Because harbors are actually working. So carefully watch what happens in China. That could bring back some positiveness in the economic sphere of growth throughout the world. And that could bode well for South Africa as well, and for emerging markets as such.
Well, you talked about Chinese ports, or Shanghai, that's opening up again, but there's a ports in the Black Sea is a problem, getting grain out of Ukraine, which affects our food prices, doesn't it? Because the blockade of Russia of Black Sea ports.
Yeah, certainly, you know, I mean, we've spoken about the effect of the high oil price and the effect of that on logistics and cost of food and so forth. But what is also a problem is the whole Russian-Ukraine war situation, both countries being very big producers of grain. And that's got a very big impact on the supply of grain throughout the world, and obviously the prices of grain and maize throughout the world. And that will definitely also have a negative impact on food prices. So certainly within this whole inflation debacle and a Russian and Ukraine war, it's not just the fuel price that gets hampered by that, it's also food prices. But that just places, as I said, more and more pressure on the consumer that is already on the brink of breaking down because of all this increases in prices and the decline in their disposable income.
We talked about it informally once, about the fact that fuel levies in South Africa, we're talking about that and we're asking the government do something about it. But I think what South Africans don't realize, that fuel levies in other countries are sky high. I mean, are such a big part of the petrol price. An example is the UK.
Yes, I mean, we're speaking about the R1.50 levy that was sort of being discounted for us for a period of 2 months. And yes, there's a lot of talk about the fuel levies in South Africa and taxes on fuel. That's very high. But if you start comparing our fuel price, the base price of fuel in South Africa versus the base price of fuel in other countries is very much the same. Because it's based on the same commodity. If you look at the UK, you look at France, and you look at a lot of other countries, their fuel levies is just as sky high. They also use fuel as a space where they can raise lots of money for the fiscus. It's quick money. It's distributed amongst people that actually use it. So it's like that. It's a very easily collectible tax. But sometimes I think people complain a little bit about our taxes and our levels, but that's not actually that high if you compare it to certain other countries. What is very true is the impact of that on a very big part of our economy, in the sense that a lot of our people falls into the sphere. We don't have the same sort of public transport systems that other countries, first world countries, have. So yes, their fuel levies might be higher than ours, but there's less dependence of the human being on the car, and there's a lot more dependence on public transport. We do not have that. Our public transport gets filled up at a petrol station with either diesel or fuel. So an increase in the fuel price has got a very direct impact on the people using taxis, because that's their public transport system. There's no trains and trams and all these sorts of things, So it's very bad for the South African, especially people at the poverty end, and finding it difficult to make ends meet, because there's a direct hit on them, and just takes money. They have to get to work to get a little bit of money to be able to buy food. And now a far bigger percentage of their money goes towards getting to work and less in terms of food. So, this has got a very bad impact on South Africa. So, yes, we've spoken about it, as you said. And I was the one that said, fuel levels in South Africa is not always that high. But there's a very unequal distribution of wealth in South Africa. So the impact of it on the poor people in South Africa is far more dramatic than it is in other first world countries.
Yep, that's true. But it's an excuse for middle class people to say, no, we're going to work from home. We're not returning to the office. It's too expensive to get there.
That's the other one. You see, the higher you go up, if I can speak like that, in terms of the food chain, in terms of earning salaries and the seniority that you have in your job, the more ability you have to actually manage some of your expenses. Whilst the people at the bottom end, that we've now spoken quite a bit about, have none of those abilities. They have to get up at 5 a.m. They have to stand in a queue. They have to get a taxi. They have to get to work just to be back home by 7 o'clock or 8 o'clock again tonight. And they have to pay that increased prices. And in South Africa, if the fuel price goes up with 15 and 20% at a time, we're definitely going to have an impact on what happens with people's income. And that will have an impact on their socio-economic standing, can even have an impact on riots, etc. Because this people is really at the bottom end of the chain.
Yeah, and people are at the end of their tether. Always nice speaking to you, Andre Cilliers from TreasuryOne. Thanks, Andre.
Thank you.